Stop transcription. Just want to make sure. Okay. So again, good evening to tonight's lecture. It's your module 1, your introduction to insolvency law, and we will do an introduction, as mentioned, as an overview of the structure of insolvency law. Just a roadmap. How do we actually approach this this program? You will have a lecture on each of the modules. There will be slides made available under that specific module. You'll have a reading list, and the reading list is basically your scope for the exam, as I mentioned last week as well, of last time I saw you, or you listened to me. So the reading list will form the scope. Will actually, so on the reading list, you'll see that there will be some reading material, articles, as well as case law. And yes, then we have the assignment, and I'm just finalizing the assignment with the moderator. That will also be made available, and obviously the exam. All the dates, I'm waiting for confirmation, but it looks like I have managed to convince everyone that the exam date could be early January, and I will confirm that date with you as soon as I have confirmation. If you then, after we've confirmed the date, need a letter for your employer, please let Lefa know, and he will assist you with such a letter confirmation of exam date. So, lecture, slides, reading material, assignment, and exam. Again, I just want to confirm that with the assignment, I'll have a specific lecture where I will go through the assignment with you. There will also be a recording which you could listen to, which will give you exactly an idea of what the expectation will be for the assignment, and then obviously we will have an exam prep session as well. So please do not stress. You will have all the information available, and you will be able to actually do everything in your own time as well. So tonight's lecture, we start with an introduction and an overview of insolvency law. Yes, there's been a lot of law reform post-COVID as well, in specific jurisdictions: India, Singapore, Australia, new UK Act as well. And then various other jurisdictions have been looking, Ghana has been looking at law reform, and they have actually been trying to finalize the law reform and make sure that everybody has access to the legislation. So it has been quite a long road, a long and winding road for South Africa. We have started with a law reform process in the late 1990s. And in 2000, we actually also looked at the South African Law Reform Commission and a draft bill. There was an absence of the business rescue model, and then it all came to a screeching halt, and we are still waiting in anticipation for this new insolvency bill. There's again rumors of this particular bill that is doing the rounds. Then we also have the unified or the relatively new Companies Act, which actually the Companies Act of 2008 was enacted in 2011, and basically just made a few changes to the companies law, but also very important, it gave us Chapter 6, the business rescue. Policy considerations. So if we look at insolvency law, if we think insolvency law, the first thing we should realize is there's certain policy considerations. And one of the most important is this, and it is a Latin word, but yes, it simply means concursus creditorium, simply means the coming together of creditors. regarded as one of the key concepts. And it's just basically that you now, the minute that there is an insolvency order, will have a look at the preference of the group as opposed to that of an individual creditor. So this, long ago, Walker versus Seifert in 1911 explained this key concept, and it is literally the basis of insolvency law. The sequestration order crystallizes the insolvent position. The hand of the law is laid upon the estate, and at once the rights of the general body of creditors have to be taken into consideration. So no longer a free for all, no longer individual creditors, but the group, the general body. No transaction can thereafter be entered into with regard to the estate by a single creditor to the prejudice of the general body. So again, we look at the general group, and that is what a difference is between insolvency and business rescue as well. We do not have this policy consideration of a concursus creditorum in business rescue as opposed to liquidations. What is the object? Why? What? How? Why? What? How? So the object of insolvency law is to ensure a due distribution of assets among the general body of creditors. So equitable distribution. And this is not the primary object, is not to grant relief to debtors. It's a pro-creditor system. And again, this is as opposed to business rescue, where we have a balance of rights as in Section 7K of the Companies Act is prescribed. So there's the requirement of an advantage to creditors in Section 4 of this act, which serves as a prerequisite for the sequestration application. And this confirmed this pro-creditor approach that we have in South Africa. It is a bit archaic because in most other countries, they have now opted for a more of a reconstruction of the state and restructuring of the state, and moved away from the strict pro-creditor to a more balanced approach. So we are a bit behind in that. Aim of insolvency law. So the law of insolvency can be described as the rules that regulate two different concepts. The one is the factual insolvency, where its liabilities exceeds assets. So it's literally a liabilities, exceeds assets. And then the commercial insolvency, which is the mid-month cash flow, unable to pay debt situation. So those two concepts will be very important when you have to make a decision on whether you are going to wind up a company in terms of the New Companies Act or the Old Companies Act. So the Insolvency Act does not define insolvency. It just gives us a definition of insolvent estate. So here are the important concepts. So the aims of insolvency we looked at, then sequestration versus liquidation. So we often use these terms. You sequestrate an individual, you liquidate a company. Winding up of a company, sequestration of an estate. Your concursus is the coming together of creditors. Your factual and commercial insolvency is liabilities exceed assets, or then your cash flow issue, you're unable to pay debts. Although you have more than enough assets exceed liabilities, but at that given time, unable to pay debts. And then you've got your different types of creditors that we will have a look at now. So which persons can be sequestrated? If we look at Section 2 of the Act, debtor, and this is just, you can read this, but just to confirm that in connection with sequestration, it's a person, it's a partnership, and it excludes a company. Company will be wound up in terms of the Companies Act. And that is both the Old and the New Companies Act. And then if you've got your Matrimonial Property Act, if you've got a estate that is in terms of the Matrimonial Property Act, you will read Section 17.4, in communion of property, you will make sure that, you will have only one estate. So that is then important to realize that in the process of insolvency law, you will often deal with definitions. And definitions becomes important because you often have, like, for instance, in insolvency, definition of security, definition of a debtor, and here we've seen that, Section 2 describes the debtor for us. And then you're obviously 17.4, if you married in community of property, one estate. The role players, important, the High Court, not as much the Magistrate Court, the Master of the High Court, and we will listen to a lecture on the Master of the High Court, and then the liquidators or trustees, also referred to as practitioners, insolvency practitioners. The main sources of insolvency law, again, it's your Insolvency Act, and we're not sure when we are going to see a new Insolvency Act. Do not fear. Don't think, oh my goodness, I'm doing this old course and then there's a new act. The basic principles will remain the same. It will just be in different sections and provisions, but the basic concepts and basic principles of insolvency law is the same, whether it's in South Africa or in any other country or in any other legislation. We are going to deal with the basic principles. Then you have your two Companies Acts, the old and the new. We're not going to deal with closed corporations. Your Constitution as the most important piece of legislation, and then other legislation, like, for instance, the labor law, etc. And then your common law is your general rules regarding the courts, etc. Now, insolvency law, there's basically two modes of commencement. And the one is compulsory, where the creditor applies to court, and then you have your voluntary process, where the debtor decides to actually approach the court and decides to actually, on his or her own, decide to actually enter this process. So a compulsory and a voluntary process. I will not assess you on jurisdiction. It's very technical, other than to actually just mention to you that Section 149 deals with jurisdiction. If you need to actually read this, whenever you deal with an application for sequestration or the winding up of a company, then you will need to read Section 149, whether you are domiciled, own goods, or any time during the 12 months preceding the date ordinarily resided. It is important that you know that this is the rules for jurisdiction. Okay, so let's look at the voluntary sequestration of the estate. And this you'll find in your notes, and you'll find it in Hockley as well, in that chapter that are prescribed in the reading list. The applicants, the debtor himself, or the executive of a deceased estate or partnership, and then in a case of joint estate, both spouses, and then the formalities. Please read this. This is really not, I'm not going to go into much detail, but you have to actually publish a notice of surrender in the Government Gazette, and a copy of this notice must be sent to all known possible creditors. So there's a notification requirement, as well as this notice of surrender in the Government Gazette. Again, very archaic to have a gazette and not actually mention any social media or any other media or emails or whatever that you can send out, but only this mode of communication. Prepare a statement of affairs and you submit this to the Master of the High Court for inspection. So this is your process, your formalities. But then also, each creditor will receive a copy of this notice, and you have to send it to the registered trade union, to employees, as well as to SARS. So read section 4. Then that's your formalities, but now we get to the requirements in terms of section 6. Again, this is all in your notes and in this chapter. The applicant must prove, first of all, section, the formalities, sorry, I just had a student that wanted to join and unable to join, just wanted to assist him or her. So formalities complied with, you have to prove that in fact there's insolvency, the free residue, and we'll get to what that means now, sufficient to pay the cost, and that there is advantage to creditors. And then the court still has a discretion. The concept of advantage to creditors will be discussed in one of the articles that are prescribed. So you just need to actually read that article to just have more of an insight into this concept of advantage of creditors. Part 2 is then your compulsory sequestration. And again, there will be the requirements, a creditor, liquidated claim. What is a liquidated claim? It is an amount that's fixed. So there's a contract, an agreement, an invoice. You can see this is the amount, or the court has determined this amount. And then with a compulsory sequestration, because you are unaware of this, you have a provisional order and a final order. So you can still actually claim that your estate is not insolvent and is, bring reasons to the court why you should not be sequestrated. But again, then you have the formalities. Again, the notice of the application, the same. And then also, if there's an employer-employee situation, you have to consult with different parties. Now, please note that I am not going to assess you on these technical issues of the commencement of insolvency. This is not a civil procedure program, but I just want you to take note of this so that you just have the full picture. You can read that on your own. So again, the requirements to go to court is to establish the claim, commit act of insolvency, or there's a reason to believe that there's an advantage to creditors. And again, there is a difference between this and the other procedure, in that this would be, and there's a advantage, a reason to believe. Then there's the so-called deeds of insolvency, and I just want you to mention this one, notice of inability to pay. So we often write a letter and say, listen, I'm unable to pay my debt, I will pay it off, or I will, give me extension. And that is a deed of insolvency. And as a result of that, your creditor will be able to sequestrate your estate. All the others, you can just read on your own. I will not assess you on that. What is a friendly sequestration? So a friendly sequestration is simply that there's no arm's length. So it is you and your friend, or you and your family, or whatever, come together and they act as the applicant in this estate. And the reason for that, it is easier to prove a compulsory sequestration than a voluntary sequestration. And that's where this slipped in. But the courts caught onto this, and they actually have now decided that it is, that they will look at a friendly sequestration in a strict and a rigid manner. So they will actually be very aware of this so-called friendly sequestration, which is more or less an abuse of the system. Now, this is just, I say it's important, but it's important to think of this. Think about it. Again, not for assessment purposes, but if we just, what I've mentioned to you now about the advantage of creditors, that you have to prove that there's an advantage to creditors, and if you do not prove that, your application will not be successful. So think about Section 34. Everyone has the right to have any dispute that can be resolved by application of law decided in fair public hearing before a court, or where appropriate, another independent and impartial tribunal. So just access to court. So just think about it. If if I just think of Section 34, I sometimes wonder about the constitutional aspects if we look at that particular requirement that there has to be a advantage to creditors before you can actually. So you are down and out, can't pay your debt, and insolvency as a process is not available because you can't prove advantage to creditors. I'm not going to deal with this particular slide because we will have a separate lecture on the interaction between insolvency law and business rescue and corporate insolvency. Just for now, take note that, again, there are different modes of winding up of a company: court and voluntary. So again, same as with a person. Okay, so the classes of creditors. You have your secured creditor, preferent, and concurrent. So throughout the semester, the program, I will mention the fact that there will be different classes of creditors: secured creditors, preferent, and concurrent creditors. So your secured creditor, your preferent creditor, and your concurrent creditor are the different classes according to the Insolvency Act as well as our common law. So what is a secured creditor? It's a creditor that holds security. It's like a special mortgage bond that was registered in terms of immovable property. There's your landlord legal hypothec. For instance, there's outstanding rent and he's got he can lay claim to the movable property. Pledge: I owe you 10,000. I give you my iPad. I pay you back. You give me back my iPad. Right of retention is you do legal work, they don't pay you, you don't deliver, and etc. So these are the different types of security. Now, the minute that you register a mortgage bond over immovable property, just pause there. The immovable property is then referred to as an encumbered asset. It's encumbered with security. So the security will give that particular creditor a secured claim. It will be referred to as a secured creditor, a secured claim, and an encumbered asset. And the proceeds of that particular asset will then be paid to that secured creditor. So that creditor will have preference. As opposed to this concept of a free residue, this is all other assets in the estate, not subject to security, which will be sold. The laptops, the couch, the television, etc., all into one kitty, one account, free residue, and this is then the portion of the estate not subject to security. This is a very important concept and account because what happens? The classes secured, preferent, and concurrent. Secured holds a security and preference over that encumbered asset. But these two, a preferent creditor and a concurrent creditor, a list of preferent creditors, statutory preferent creditors in your act, and then last of all, the type of credit does not enjoy any advantage and are paid from the free residue. So both of these, the statutory preferent, which would be SARS, employees, etc., list of them 97 to 102 in your Insolvency Act, and then your concurrent creditors also paid from the free residue. So think about it. There's the estate, there's the encumbered asset, the immovable property with your secured creditor being paid from that, and then all other assets form the free residue, and this must be paid out of that free residue. However, there's a catch. The cost of sequestration also first in line. So you will first pay the administration cost, and then comes the preferent creditors, and last but not least, your concurrent creditors. As I mentioned, we'll not spend too much time on Companies Act. There will be a separate lecture on the interaction between Companies Act and insolvency law. And that's why I have just made summaries for you if you want to read this for now. Now, I've also included the business rescue just briefly because I want to refer to business rescue and the interaction throughout this program. So let's touch on this. It's business rescue is the alternative to be wound up. Financially distressed companies would have a choice either to liquidate, wind up, or then the business rescue proceedings. Okay, so an application for business rescue must be preferred over a winding up. So introduction to business rescue, it replaces judicial management. That was the old business rescue in inverted commas. It was then shut down by the courts and by everyone. And then we see that we now have Chapter 6, provide for efficient rescue and recovery of financial distressed companies in a manner that balances the rights and interests. So can you see here we move away from that very rigid creditor-friendly environment to a more balanced approach, and you have to give preference to business rescue. I'm just going to include the definition of business rescue. This is the 3 pillars that we built different business rescue. So section 128 tells us that business rescue is the temporary supervision of a company. So you remove the board of from management, you replace them with a business rescue practitioner. There's a temporary moratorium. Now, this is as opposed to the winding up of a company or a person where there's no such thing as a temporary moratorium, where you tell your creditors to stay. They do not have a claim at that moment. They can't act at that moment. And then the third pillar is the development and implementation of a plan. But there's a dual purpose here. We hear about business rescue. So yes, plan A, but also there should be a better return for creditors that can also be used. So there's a dual purpose. Either you rescue plan A or plan B, there's a better return for creditors. Okay. And that is your dual function of business rescues. You often hear that there's a structured winding down of, say, for instance, a mine, where there is retrenchments. They do sell the property, but they do so under Chapter 6 and not the Companies Act, the liquidation provisions. So financially distressed, there's no definition in your sequestration, your Insolvency Act, or your Companies Act in general. But in Chapter 6, we find that the company is financially distressed, they're unable to pay their debts or become insolvent within the ensuing 6 months. So more or less, you look into the future and decide whether this company, and the reason for that is to enter business rescue in time. And then obviously business rescue versus liquidation, a lot has been said about SAA, ComAir, Edcon, Tonguard, all these very high profile matters that have been dealt with in business rescue and liquidation, and there you have a choice. So tonight we've just touched on the framework for the sequestration of an individual, your voluntary process, your compulsory process. We've also seen that there's 2 different modes of a company to be wound up, again, voluntary and compulsory. And then we also touched on the alternative to a company being business rescue, so that if I refer to it, that you are aware that that is that Chapter 6 procedure that we have in the 2008 Act. So this is a broad overview of what we are going to discuss. So I'm stopping the recording because I'm now going to just